And so think about this. When you're alive, when you give money to a charity, the IRS gives you something in return. What is that? I donate to a charity, they give me a tax deduction. Let's say that you own a piece of property. You've had it in your family for 50 years. You bought it for $20,000, and now that area is starting to get developed. Commercial stuff's moving in, residential stuff's moving in. You know, you bought it for $20,000, and now some developers want to buy it from you for $2 million. Does a tax bill, capital gains taxes, sound exciting on the difference between $20,000 and $2 million? Because that would be $1,980,000 of a capital gain that taxes would be owed on if you kept the money. Obviously, you can roll it, 1031 exchange into different things. But let me ask you this. If there was a way the property could be sold, you could use the money as income, not have to do a 1031 exchange, and 100% legally avoid capital gains taxes, is that something that a person like that would be interested in? Probably. It just depends on their situation, right? So that's what we're going to be talking about today in our lesson on the board called a charitable remainder trust. Now, there are a lot of different trusts. There's a lot. I'm not going to go over. I was about to list a whole bunch of things, right? But most people, know of like a family trust, or just like the basic, get it set up and be done with this. But this one is really exciting. I remember in 2005, I learned about a charitable remainder trust. It was shown to me one time, and this isn't typical for me, but it was shown to me one time, and it just was ingrained in me, and I just got it right away, and have since adapted explaining it in even a simpler way than it was explained to me. But it was just the most incredible thing to me at the time. And again, now, it's just a tool that works for people that are in the situation. But I remember seeing it, and I just thought, oh my gosh, that is the most incredible thing I've ever seen. Everyone has to know this that has this situation that could benefit from it. So let's talk about who potentially would want to even have a conversation about a charitable remainder trust. How does it work? What is it? Why would somebody ever use it? So first of all, if somebody has any asset that has capital gains attached to it. So, like somebody has a business that they buy, they put equipment in, and they're going to have a basis, which is the amount that they bought it for, plus what they put into it, plus maybe some depreciation and some other things, right? But they have a business that if they sell the business and they keep all the money and they stick it in the bank, they're going to owe capital gains taxes on that. Okay? Then maybe you have some stocks. It works the same way. I buy a stock for $1. I hold on to it for 50 years. It's now worth $300 a share. I sell all my stock. I pay a capital gain from what I bought it for compared to what I sell it for. Okay? So that's going to be another one. Another one is going to be land or properties, not a primary residence, but maybe some investment properties. Maybe I'm a farmer and I've got a bunch of land and I want to sell that, but it's been in the family for a long time, and I'm paying all these property taxes on it, and I like the idea of owning the land. It's it's not developed or anything like that, but I own it. I'm paying all these property taxes on it, and I'm just done. I'm done paying property tax. I'm not going to develop it. I just want to sell it. What stops a lot of old farmers from selling is capital gains, of all the capital gain that they're going to have to pay. Or let's say I'm a real estate investor. Okay, I'm actually working with somebody right now in their late 70s, both 78 years old. They've been doing real estate investing forever, and they are just sick of property management companies or hiring their kids to do it or doing it themselves. I mean, 78 years old, they were at one of their properties the other day planting flowers, which hopefully the freezingness of Utah didn't kill those. But they're over at their own property. Now, could they hire someone to do that? Yes. But that costs money. And it's just things to deal with, and they've got like 30 grandkids or more, because I think they have like 9 kids or something like that. But anyway, and so they would rather spend their time doing that than checking up on property management companies, make sure the property's good, renters in there, blah, 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 blah. But then their biggest hang-up was if we sell all these properties, they had 4 of them, if we sell all of them, the capital gain, because they've been doing it for so long, was pretty significant. It wasn't like crazy, but it was pretty significant, several $100,000. So somebody that's in that situation, that's where a charitable trust could fit, is that they have something that has a capital gain that they want to potentially and legally avoid, because that's the only way that it should be done is legally, right? And so they might talk to their CPA, and CPA says it can't be done unless you do a 1031 exchange, which is moving money in from like to like, which people can do. But to do a charitable trust, what they would want to do is if they can, step 1, get the trust set up first. Okay, it has to be set up before there's a written offer on the property. Okay, there have been cases, and again, if someone's taking this as like legal advice or tax advice, I'm not giving it, but there are ways, even if there is a written offer, to make sure that you still fall within the guidelines of the charitable trust and all the laws and everything, and make it work. Okay, but best is to have the charitable trust set up before there's a written offer. Part of setting up the trust, so we'll say step 2, is choosing NPO, which is a nonprofit organization. It's called a charitable remainder trust because there's a charitable gift involved in this trust. Now, how many people, when they get to retirement age, that's part of what they want to do, is they want to give more. They want to be a part of charitable organizations and things like that. And so this is something that could have been their intent all along. When they died, they were going to leave a certain amount to a charity anyway, or it's something that, if it benefits the charity, it benefits them, it benefits their kids, that it's something that they feel like they could do and stand behind and want to have as part of their legacy that they leave. And so you set up the trust. Obviously, that has to be done with a highly qualified and knowledgeable attorney that can set that up. They choose a nonprofit organization. Another very important thing, we'll put that as step number 3, is to find a CPA, not just any CPA. Okay, any CPA is not going to do. They need somebody that has dealt with, maybe been kind of like a third-party administrator for charitable trusts. And yes, they will have to pay them, but what they're going to have to pay to make sure it's done right is going to be way better than having to back pay any taxes and penalties, etc. So they get a competent CPA that's dealt with these type of trusts before to make sure that all the tax calculating and tax deductions, etc., are done correctly. Okay. Then they're going to work with a financial consultant, financial planner, financial advisor, whatever you want to call it. Let's just call it the money person, to make sure that the accounts that this money goes into is set up properly, and if a life insurance trust is used, which isn't always used but can be used in these overall plans, if that is implemented. Okay, so what does a charitable trust do? Basically, what happens is they have whatever they have. So let's say it's land. So here's their here's their land over here that they're going to sell. If they sell it and they don't have the trust, then it's the actual person that owns the property, owns the trust, or maybe it's an LLC. They receive the money. If they don't 1031 exchange that into new property, new business, new land, etc., that's a taxable event. But if they have this set up in a trust, when they sell the property, let's say they sell it for $1 million, then all million is in the trust. And so that $1 million is not subject to the capital gain, as long as, again, this is set up right. And so they legally and honestly and ethically avoid the capital gains tax by having a charitable trust set up. And so this charitable trust, now the money moves into that. That has to go into an account of some kind. Maybe that's let's just say it's a bank account. But regardless of where it goes, the money moves into the trust, and they don't have to pay that capital gain. Okay. Then what happens is over here they've picked a nonprofit organization. Let's say it's the Boy Scouts of America or the Red Cross or a church or whatever they pick. The reason it's called a charitable remainder trust is whatever remains in this trust goes to that nonprofit when they pass away. So at death is when that would happen. And so think about this. When you're alive, when you give money to a charity, the IRS gives you something in return. What is that? I donate to a charity, they give me a tax deduction. Well, when is this money going to be given? When I'm dead. Can't get in a tax deduction when I die. So they actually give you, using a special calculator, they give you a tax deduction while you're alive. Depending on, and this is working with the CPA now, depending on how much you take from the trust each year. Now, it can be deferred in the charitable remainder trust, but typically people are moving it in there to start taking an income right away. And there's no maximum limit, but once they start taking money from it, there is going to be a minimum that they're going to want to take or need to take each year to follow all the rules. And again, this isn't some like super simple thing, but it's a trust that helps us leave a legacy and avoid some unnecessary taxes. It doesn't avoid all taxes, but helps us minimize a lot of unnecessary taxes. So most people that we've seen will take somewhere between about 3 to 8, maybe 10% per year out of this account, because obviously they don't want this to disappear too quickly. So depending on how much the person is going to take is how big of a tax deduction, total tax deduction that the IRS gives. So with one that I'm working on currently, this is how the numbers work. If the couple was to take 5% per year from the trust, the total amount that's going into the trust is just shy of $1 million, and because of their age, because of the amount that will be given and the amount that they're going to be taking as income each year, the IRS will give them, according to this calculator, if they take 5%, they're going to have total a $530,000 credit, tax deduction. At 6%, they would have $488,000. At 7%, if they took 7%, it was $432,000. And if they took out 8%, because this is what fit within their goals, they would get a $380,000 deduction. So how does that work? That means from all income sources, Social Security, pensions, IRA, RMDs, everything that they're taking, each year they can deduct up to 30% each year of their taxable income that then is subtracted from this. Okay? So let's say they make $100,000 every year from other sources. They pull in $100,000. They decide to do the 5%. 30% of $100,000 as a deduction is going to be $30,000. So that first year, deduct $30,000 from that. They've got $500,000 left. because they can deduct up to 30% per year of their taxable income. So what that means is a lot of the time what they're pulling out of this, their tax deduction is big enough that it's saving them on income taxes as well. So not only did this couple in this example save several $100,000 in capital gains taxes, they are also given a $530,000 tax deduction from the trust because that money is going to be given to a charity when they pass away. And so that is the very basics of a charitable trust. And so obviously when you look at this, a lot of the time people will kind of shoot some holes in and say, well, wait a minute, I get to spend some money while I'm alive, but if I get a couple years into this and I die, whatever's left here goes to the charity? Yes, that is how it works. And so then there might be some heirs that are a little bit upset with that. So a lot of the time, this plan can be coupled with an irrevocable life insurance trust, where part of the money that comes from the charitable trust can fund an irrevocable life insurance trust to replace the estate that would have gone to the heirs that's now going to go to that nonprofit because of the charitable gift and because they wanted to avoid the taxes. And so it can be kind of a really cool idea, and the irrevocable life insurance trust is not part or required to have in a charitable remainder trust, because people could just do it because they want to leave it to a trust or to a nonprofit, and maybe they have a whole bunch of assets in other places that they're going to leave to their heirs, and this is part of their planning. And so typically, getting into a few extra steps and bringing some things together as we finish with our lesson today is a lot of the time what will happen in conversations with people is they'll want to do this whole part. Then as they take out this 3 to 8%, they live on some, they save some for the future, live on some, save some, especially while they're getting this tax deduction until they hit $530,000 total, and then they take a portion of it and get an irrevocable life insurance trust for about $1 million. And there are some things that you can do there. Previous episodes of the Impact School of Money, we talk about second to die life insurance plans that insure the two people or a couple. Then what happens is they're able to live on that money until that tax deduction is completely spent up. Then the money that they've been saving, remember they're living on some, saving some, life insurance trust on some. They live on this money. The money that they saved helps them pay the taxes, income taxes later on the money that they were able to deduct for the first several years of having this charitable trust. Then they pass away. They were able to live on who knows how many hundreds of thousands of dollars, 1. 2, money is donated to a charity. 3rd, their heirs get and are the beneficiaries of of the irrevocable life insurance trust or the life insurance plan, that they get that as a way to replace the estate that would have been left to them. And so what's interesting is I actually had a business owner, he was a dentist, that was told by his CPA that unless he did a 1031 exchange, there was no way that he could avoid the capital gains taxes if he wanted to use the money as income, that he should just sell his business and his building, which would have been about $2 million, pay the capital gains tax, and just live on the rest. Well, that would have cost him several $100,000 to do, plus realtor fees and all that stuff that they had to do to sell the building. So then when he met me and we showed him this, he went back to that CPA who'd been working with for years and said some pretty choice words. And then if I remember right, he started using somebody else for his taxes because he was upset that his tax guy gave him advice that was going to cost him several $100,000 that he could have avoided. Now, am I saying this is the only thing that you could do with some money from selling land? No, but it is an option. But also it starts to teach us a little bit, and as we go into future lessons that I'm actually going to be bringing in a professional from the industry to explain a whole bunch of different trusts that don't necessarily involve things that I do specifically, that I come in and consult on, but he's going to have a lot deeper knowledge on all the different trusts and how they work that could be a better instructor for this section of the Impact School of Money. So thank you for sticking with us today. You know, this was maybe a lot of information all at once. Hopefully this is something that you learned and started to see that, you know, when you combine different financial products, different tax plans, different trusts, when it comes to entities, how powerful financial planning can be that really supports the idea little by little. A little becomes a lot because it's a little piece from here, a little piece from here, little piece from, you know, financial, tax planning, etc., life insurance. You know, you learn about these things a little bit at a time, and then what starts happening in our brains is we learn about this piece of a puzzle, we learn about this piece of the puzzle, we learn about this piece of the puzzle, and then the more we learn about the pieces of the puzzle, we start to see where they overlap and fit together, and some very powerful strategies can come together as we're educated more and more about how money works. So thank you for joining us for class today. This was the Impact School of Money. Class dismissed for today. See you later.